A recent report from Bloomberg Intelligence says that it looks like gold has been taking a nap for a very long time, and Bitcoin could be the culprit of this. We'll be asking a giant in the gold space his thoughts on this today. He is David Garofalo, Chairman and CEO of Gold Royalties, also the former CEO of Goldcore. David, welcome to StansberryInvestor.com. Welcome to my show here.
Hi, Daniela. Thanks for having me on.
Well, I'm excited to have you on because I want to cover a lot of ground with you today. But first, I want to get your thoughts on this Bloomberg Intelligence report. Mike McGlone is a good friend of our show, but he says, gold's been taking a nap here. And, if we look at the charts don't lie. Since August, it has been a tough road here, David.
Yeah, well, nothing goes up in a straight line, and cryptocurrencies captured, maybe the younger generation's attention as potentially a reserve currency. And clearly there is a need for a reserve currency in this environment where there's massive quantitative easing, very low interest rates. But what the cryptocurrencies don't have is, one, barriers to entry, and two, any physical properties. There's nothing that will prevent somebody from creating another cryptocurrency to capture market share. And the fact is, it's not backed by anything. It's digital. It's zeros and ones. There's nothing physically backing it, whereas gold has been a currency for millennia. And I think investors will come back to gold in short order. I don't see an end to quantitative easing anytime soon. I don't see interest rates coming up, at least on a real basis, anytime soon. And so the opportunity cost for owning gold is not there. I think there's still going to be a massive amount of investment, and central banks will continue to diversify out of paper currencies, not into cryptocurrency, but into gold. And so there'll be a source of demand going forward for the foreseeable future.
But David, what do you make of this bandwagon that we're seeing big banks, Goldman Sachs coming out saying that they plan to offer Bitcoin to their wealthy clients, the second big bank to come out with this? So what do you make of this Wall Street embracement of Bitcoin?
Well, I think they're just following the trend. What they're offering is a product that clearly people are buying, but it's still not replacing gold as a reserve, both for central banks and for sophisticated investors that realize they want currencies and preservers of capital that actually has physical properties, something that can actually trade, use to buy other paper currencies in order to buy things. You can't really do that with cryptocurrency. Cryptocurrency is still not broadly accepted as a source of payment. For day-to-day transactions, gold is much more fungible in that regard.
I want to talk about the mining landscape with you now, David. You were involved, and I was lucky enough to be covering it at the time, one of the most historic mergers of all time, Newmont Goldcorp happening at the same time of Barrick and Randgold. So I want to get kind of your sentiment on where the mining industry is at now. Now you're at the head of a royalty company, so you've really covered all the bases, from a major, from a junior, and now a royalty. How is the mining industry doing right now, David?
Well, I think consolidation at the top is broadly behind us. There are very, very few players left in terms of the large cap gold producers, and it's unlikely you'll see consolidation among them for a number of historical reasons. And I would say that you'll see a much larger prospect or more significant potential for consolidation in the mid-tier. There are a lot of players in the mid-tier in the emerging producer space within the gold sector. And the reason they're going to do that is in order to capture the imagination of generalist investors, they're going to have to achieve scale, and they're going to have to do it quickly. And they're not going to be able to do it through the drill bit because reserves in the industry are down about 40% over the last 7 years. So they're not going to do it through building their way out. But and as you correctly pointed out, and I've said before, mine construction has become a lost art in the industry anyways. And even if the industry put its mind to building out new capacity, it would take years to achieve any scale. So in order to achieve scale, to attract that incremental investor, that generalist investor, they're going to have to do that through an M&A. And we've seen some evidence of that in the mid-tier over the last couple of years. Even in the absence of the ability to do physical due diligence, we've seen M&A in the mid-tier and the emerging producer space to achieve that scale and to achieve relevance for a lot of investors, enough scale and liquidity so that the generalist investors can start to play in the names.
Reserves, as you said, down 40% over the last 7 to 8 years. Now that more than ever, it seems to me that the juniors are vital here, David.
They are. And in fact, one of the other things I do is I run a precious metal investment fund called Marshall Precious Metals with some Chinese partners. And we're investing in those early stage juniors because we recognize with a 40% decline in reserves over the last 7 or 8 years, if you're not finding it, you're going to have to buy it. And we're seeing evidence of that. Seniors are starting to pick up and tuck in some earlier stage development opportunities to populate their pipeline. And so the juniors are becoming quite vital to deal with the existential crisis the gold industry is facing with reserves declining. That decline in reserves isn't because metal price assumptions have changed, it's simply through depletion. We're mining as an industry 100 million ounces of gold per year. We're certainly not finding that number of ounces to replace what we're depleting on an annual basis. So we're going to have to rely on the juniors to be successful on the exploration side and the early stage developers to make a strong investment case for their opportunities so that the seniors and the more mature mid-tier producers start to tuck these in and start to put some capital to work in developing new capacity.
David, with the dwindling reserves, do you feel that's reflected in the gold price?
I think the gold price is largely driven by demand more than supply issues. And I think what's driving demand right now is gold as a currency, and currencies trade relative to each other based on relative interest rates. Gold yields zero, and the fact is sovereign debt yields negative in both real terms and in many cases nominal terms. And so that's driving demand for gold. Supply, I think, helps with the sentiment, and I think we've achieved peak gold supply in the industry, but I don't think it necessarily drives the price on a day-to-day basis like demand does. But the supply issue is definitely real, and it does drive sentiment positively towards gold, in my view.
David, how did the pandemic impact M&A activity on the mining front? As you know, we had the PDAC, BMO, all basically virtual events, and this is such an important, or are important events for mining CEOs to network, the essence of M&A activity. With the absence of that, how did that affect M&A this year?
Well, it's not only the networking, and by and large, we've been able to adapt to the Zoom world as we are doing right here, right now, and we're still able to talk to each other, and CEOs do talk to each other, and deals are happening. But I think the volume of deals would be significantly more enhanced if we had the ability to do physical due diligence on each other's assets. And we've been able to adapt by hiring in-country resources to do that due diligence, but it certainly has impeded the ability to get to assets and get to sites. And I think there's going to be a pent-up amount of activity, M&A activity, once we get to more normal travel protocols going forward. Once we get out of this COVID crisis, I do see a pickup in the pace of M&A, even though it's already been quite active. Because again, the industry is dealing with an existential crisis given the state of the reserve position. We've gone from 20 years of average reserves over the last 7 to 8 years to just 10 years. That is an existential crisis when you consider from discovery to first gold production, you're looking at minimum 10, 15, as high as 20 years. So we're not going to turn around that downward trajectory in reserves and production anytime soon. So we have to get up and get going.
But what's it going to take to find that next big gold reserve? Obviously the juniors exploration, but how likely that it will happen, let's say within the next 5 years?
Well, I think there will be significant discoveries in the next 5 years, and that's because we're putting capital into the ground finally. A little over a year ago, we started to see capital flow back into the junior sector, which is why we established the Marshall Fund with the partners that I did. Is we foresaw a need to see capital deployed in the ground in exploration. And the old adage Wayne Gretzky used to use, you miss 100% of the shots you don't take. Well, we weren't taking shots until about a year ago. There wasn't any significant exploration. Now we are taking shots, and I expect there'll be discoveries. But even when there are, we're not going to see the evidence of that in production for many, many, many years. Because as I said, the lead time from that discovery hole to first production is minimum of a decade, but more likely 15 to 20 years in many cases, depending where the deposits are located or how geologically complex they are, how capital intensive they are. That really drives timelines in a significant fashion.
In the past, you've said that juniors couldn't raise money to save their lives. That since has changed. But what was the change? Why are they better positioned now? Is it just because we have a higher gold price and that interest is there, or there's something more at play?
Yeah, I'd say both the gold price, and we had some positive sentiment leading at the beginning of 2020 on the gold price, and that's somewhat abated now, but I'd argue that's coming back. It's taking a breather, but it will come back. But the other thing is, the seniors are starting to realize that they needed to replace the reserves. And I would say, look, the producers have done a great job of running their businesses as businesses over the last half a decade or so. They've harvested their assets extremely well, kept their costs contained, generated really strong returns, returned capital to shareholders, deleveraged. The industry has effectively net zero debt right now. I can't think of a time in my 30-year career where you could say that about the gold industry. So the balance sheets are strong, but what's weak is the foundational element of the businesses, which is the reserve profiles, which are all declining, and production profiles, which will inevitably decline given where the reserves have led over the last 6 or 7 years.
David, I mentioned earlier you were involved in one of the most, historic mergers when you were the CEO of Goldcore. And like I said, I covered that news, interviewed you at the time, but I didn't get to ask you, the lessons or the takeaways you walked away uh, from that with.
Well, the lesson was the scale is extremely important. Diversification of the portfolio is extremely important, and that's been evidenced in what's happened to Goldcorp's shareholders since then.
Mhm.
If they held on to the stock, because it was a stock for stock transaction at Newmont's peak value, was 70 odd dollars. Goldcorp shareholders realized a 3 times return on that investment from the day we announced that deal, because we diversified, we scaled, and we became much more relevant to the generalist investors in the space who are looking for that scale and liquidity in their gold stocks in order to participate in the sector.
Really, really interesting times. And now here you are, the CEO of a royalty company. So you've really come, you've done it all now, David. So how is it different, leading a major, a junior now, and now a royalty play?
Well, look, I think the royalty plays are an important part of the ecosystem in mine development,
Mm.
and so where I position myself in this career is very much at the earlier stage part of the value creation spectrum in the mining space. I'm focused on juniors with the Marshall Precious Metal Fund, and royalty companies provided an important source of capital for mine development. They have acted as a bank for mine developers. And that's what we intend to do with Gold Royalty, and what the Francos and the Wheaton Precious Metals have done over their careers, over the years that they've been in existence. If it hadn't been for Wheaton Precious Metals when I was running Hudbay, we would not have been able to build the $2 billion Constancia project in Peru, which is a large-scale copper mine that's still active and a core asset for Hudbay. But Randy Small cut me a check for $750 million for our gold and silver, which was only 5% of our revenue stream. So without those players in the mining industry, we really can't survive. They can't access capital cost effectively. And streaming companies have always been a cost-effective source of capital for both the base metal producers who have byproduct precious metals, and even some of the gold producers that are looking to stream some of their precious metals in order to get cost-effective capital to develop their assets.
Finally, David, we started talking the gold price. Let's wrap on this note, because look, there's a lot of investors out there frustrated with the gold price, although it's not a low gold price by historical terms. But yeah, they want to be over 2,000 again, and they're frustrated, obviously, by the performance of a lot of the miners. So what's your takeaway for them? What would you want them to know?
Well, what I would say is the industry's never been healthier. It's run very, very in a very disciplined fashion, more so than it ever has been, with a focus on margins, returning capital to shareholders. And now we have to start to devote capital to development. And I think what will drive sentiment positively for the sector is additional discoveries. I think discoveries are important to demonstrate you're growing the value of your business in the ground, finding value in the ground that people didn't know it existed, and creating that value in the marketplace. I think that's an exciting element that's been absent for the last half a decade or so. And so I think there's going to be growth in value of businesses, not just harvesting and returning capital to shareholders. That's an important element, but I think that's an exciting element for gold equities going forward. And as I said, the gold price is taking a breather, but nothing goes up in a straight line. But all of the elements that have driven gold to this point will continue to drive gold going forward, which is to say, low interest rates, quantitative easing, the undermining of fiat currencies, which has driven capital to gold in the past. And today, there's more ways to play gold than there ever has been for generalist investors. You can buy the physical. ETFs didn't exist 20 years ago.
Right.
It was very hard to buy physical gold. Now it's very easy to do that. And what the royalty companies provide is a way to play an ETF-like product with the expiration upside, which you can't get in the ETF. So there's so many ways to play gold in the gold equities, the gold royalty and streaming companies, and the physical. And so it's much more available to generalist investors than it ever has been.
Well said. David Garofalo, always a pleasure speaking with you. Come back anytime.
All right, thanks, Daniela.
And thank you for watching. We'll have much more for you on StansberryInvestor.com, so be sure to stay tuned. That's it for me. I'm Daniela Cambone.